This is into Chapter 7 Problems 12, 13, and 14 from the CFA Institute textbook, Corporate Finance, A Practical Approach. We're given a lot of information to apply to the companies, but we don't need much of it. Let's go ahead and read it. Janet Wu is treasurer at Wilson Paper Company. They make paper products for the office and school market. Wilson Paper is selling one of its divisions for $470 million in cash. Well, that's good. Wu is considering whether to recommend a special dividend of $70 million. So we just got a big pile of money. Do we give $70 million of that big pile of money to the shareholders? Or maybe do we buy back shares of stock? Okay. So that's one question. She is also reviewing some effects of the buyback on the company, on the company's financials with the company financial analyst. Wilson has a long-term record of gradually increasing earnings and dividends. Yay, Wilson. Wilson's board has approved capital spending of $15 million to be funded out of this year's earnings. And we got the table information. We got a book value equity, number of shares outstanding, 12-month trading range, current share price, after-tax cost of borrowing, estimated full-year earnings, last year's dividend, and the target debt and equity mix. All right. 7.12 says, in investors' minds, Wilson's share buyback could be a signal that the company is A, decreasing its financial leverage, B, views its shares as undervalued, or C, has more investment opportunities than it could fund internally. All right, so if they're talking about buying back shares, when you buy back shares, you increase your financial leverage. You're reducing the level of equity, so it's going to increase your financial leverage. So A is not it. B, views its shares as undervalued in the marketplace. Well, if they thought they were overvalued in the marketplace, they wouldn't be buying them themselves. They'd be selling them to idiots who would pay too much. We can see up here the share price is currently $35 and the range has been 25 to 35. Okay, so if they're considering buying back the shares, they must think 35 is a pretty good price. And C, has more investment opportunities than it could fund internally. If they've got more investment opportunities than they could fund internally, they're not buying back shares, they're borrowing money and or keeping all the equity they have to do those investments. So the answer is B. They view their shares as undervalued in the marketplace. That would be the only one that would actually make sense from the theory standpoint. 7.13, assume Wilson Paper funds its capital spending out of its estimated full year's earnings, or its estimated full year's earnings is $25 million. If Wilson uses residual dividend policy, and what that means is residual dividend policy is we'll give back anything we ain't using. All right, they've already identified that they have $25 million in earnings, and it says up here that they also want to do $15 million of capital spending. Okay, so if they're going to use $15 million of this for capital spending, then that'll leave $10 million available for dividends. Okay, so which one of these implied dividend payout ratios? If you're going to pay out $10 million in dividends out of the $25 million in earnings, the answer is B. That's about a 40% payout ratio. All right, and 7.14, the most likely tax environment which the shareholders would prefer repurchase instead of dividends is one in which, all right, take them one at a time. A, the tax rate on capital gains and dividends is the same. If it's the same, then the shareholders are indifferent between, they don't have a preference. If capital gains tax rates are higher than dividend income tax rates, then they would prefer dividends instead of share buybacks, because the share buybacks will increase their capital gains and thus lead to capital gains taxes. So if their tax rate on capital gains is higher, they don't want capital gains, they want dividends, which C is the only one that'll make sense. If the capital gains tax rates are lower than the dividend income tax rates, then I would prefer a share buyback because it'll generate a smaller tax impact on my overall wealth. So that answer is C.